2016 has been a turbulent year, reflecting the huge challenges facing the global economy, as well as the high levels of investor uncertainty. A great example of this uncertainty and fear is the fact that close to $12 trillion of debt, sovereign debt, is currently yielding negative yields. This is clearly unsustainable long term and poses huge challenges for the likes of pension fund trustees. Brexit, it's marked a negative for global growth, and we're currently seeing corporates as well as the market revising down growth expectations for the US, for the EU, as well as Japan. Some market commentators are starting to talk about the probability of a recession, global recession in the next 12 months increasing. Some put in the probability as high as 40%. The likelihood is that what the effect of this is going to have is pushing monetary policy normalization out even further. And I think it's fair to say investors face a very challenging global backdrop. It is very easy to get lost in the noise, and one should always stand back to see what is really happening. Year to date, emerging markets have outperformed developed markets by 5.4% in dollars to the end of June, and in fact in June itself outperformed by 4.6%, despite a negative shock from Brexit. Now this is interesting. The last 5.5 years, every time we've had a negative volatility shock in the markets, emerging markets have underperformed. They've underperformed largely on the fear of US monetary policy normalization, of the fact that GDP growth differentials between emerging markets and developed markets have been narrowing, the end of a commodity super cycle, and as well as general fear around China slowdown. So the right question to ask is, what's changed? Well, I think the biggest thing is positioning. Emerging markets have seen tremendous outflows the last 5.5 years, and global investors are very underweight emerging markets. The emerging market currencies themselves have been under significant pressure, reflecting global pessimism towards the asset class. And now we're finding valuations themselves are extremely attractive. If you compare the underlying emerging market economies compared to developed market economies, their economies are actually very attractive, facing a lot less of the structural pressures than they do in the developed markets. And in fact, some of the individual economies themselves within emerging markets have got self-help drivers which are independent of the global economy. Based on the extremely challenging macro backdrop, investors are constantly asking where to invest. Well, we are convinced now is the right time to start allocating capital to emerging markets. What do we know? We know that over time, emerging markets significantly outperform developed markets. All the structural drivers of that outperformance are in place and ready to reassert themselves. Valuations themselves are extremely attractive, and investors can benefit tremendously by diversifying into emerging markets by not only increasing their return, but actually bringing down their risk, as the data shows. Here at Denker Capital, our approach remains unchanged. We look to invest in great businesses which are attractively valued. Volatility we do not see as risk. Volatility creates opportunities, and we believe we're very well placed to capitalize on them. Currently, we're finding many opportunities to invest in exceptional businesses which are trading well below our assessment of fair value. Emerging markets themselves are cheap, they're unloved, and they're underowned, and it looks as though the next cycle of emerging market outperformance could have begun.